Hi, I'm David Stein of Money for the Rest of Us, and in this video, I'll discuss what causes inflation and deflation and why central banks don't target 0% inflation. Inflation measures how the general price of goods and services rises over time. As inflation increases, the purchasing power of the dollar or other currency is reduced. A dollar buys less today than it did 50 years ago. A dollar worth of goods or services in 1967 would cost $7.33 today. Or put another way, a dollar today, in terms of its purchasing power, is equivalent to 14 cents in 1967. Even a period of low inflation reduces purchasing power over time. Something bought in 2007 for $1 would cost $1.18 today due to inflation, which means a dollar today is worth only 85 cents in 2007. Inflation occurs because the amount of money in the economy increases at a faster rate than the amount of goods and services available to purchase. If the amount of new dollars available to buy goods and services is greater than the amount of new goods and services produced, then that will push up prices. Now, the primary activity that leads to the creation of new money is commercial bank lending. And I have a video on that, on how money is created. Through the magic of accounting, whenever a bank makes a new loan, it creates a new digital bank deposit, which the borrower can then spend. The more the bank lends, the more money is created, and the greater the risk inflation will accelerate. Central banks, such as the U.S. Federal Reserve, are responsible for making sure banks don't lend too much. Central banks pay close attention to the capacity of the private sector to produce goods and services. If capacity appears constrained, yet banks are accelerating their money creation by lending, then inflation can rise faster than the central bank's target, which is 2% annual inflation rate in the case of the Federal Reserve. A key measure of the private sector's capacity to produce goods and services is employment. As the unemployment rate declines, it becomes more difficult for employers to fill jobs needed to expand the production of goods and services. In a tight labor market, businesses compete for new workers and try to keep existing employees happy by increasing their wages. As wages increase, businesses will often raise the prices of their products and services in order to keep existing profitability levels. And rising prices, as we've seen, is what inflation is. Economists and central bankers believe there is a level of unemployment called the non-accelerating inflation rate of unemployment, NAIRU for short, below which wage pressures increases and inflation rises. This is an unobservable unemployment rate. But Janet Yellen, chair of the Federal Reserve, recently stated that she and the Federal Reserve Open Market Committee, which is responsible for making sure inflation stays close to their target, believe the normal long-run rate of unemployment, which is another name for NAIRU, is 4.6%. Now, currently in the U.S., unemployment is 4.3%, so we're just below that NAIRU rate, where inflation could increase as wage pressures rise. Now, what is unknown is if the national unemployment rate falls below the NAIRU level, like it is now, will inflation increase gradually above the 2% target, or will it spike higher? In other words, is the relationship between unemployment and inflation linear or non-linear? The primary mechanism the Federal Reserve and other central banks use to control the amount of bank lending or money creation that leads to inflation is through adjusting interest rates. The Federal Reserve sets targets for the federal funds rate, which is the interest rate that banks charge each other for overnight loans. Although the Federal Reserve adjusts the target for this overnight interest rate, their actions and communications influence longer-term interest rates. The Federal Reserve Bank of Philadelphia stated, a lower federal funds rate reduces banks' cost, which then leads other market interest rates, such as bank prime lending rates and mortgage rates, to fall as well, which lowers the cost of capital for firms and households and thus stimulates borrowing and hence the economy. In theory, there is a level for the federal funds rate called the neutral federal funds rate that keeps inflation near the 2% target while maintaining full employment, which is a condition when anyone that wants a job can get a job. In other words, the neutral federal funds rate is the rate at which unemployment is at or near the non-accelerating inflation rate, and prices are generally stable. When Janet Yellen was CEO of the Federal Reserve Bank of San Francisco, she used the story of Goldilocks and the Three Bears to illustrate the neutral federal funds rate. She stated that monetary policy should be at neutral only when economic conditions are just right. More often, we do not have a Goldilocks economy. Either unemployment is too high or too low, or inflation is too high or too low. When the Federal Reserve believes unemployment is too high or inflation too low, it lowers the federal funds rate to encourage more bank lending and money creation, which can stimulate the economy and increase inflation and employment. And if unemployment appears to be below the non-accelerating inflation rate of unemployment, and inflation and wage pressures are rising, then the Fed raises its policy rate in order to discourage lending and money creation. But that begs the question, why is 2% the Federal Reserve's inflation target? Wouldn't a 0% inflation target be more appropriate so there's no inflation at all? While there's no limit to how high the federal funds rate can be set to combat inflation, such as the 20% Fed funds rate in 1970 and 1980, there is a theoretical floor to how low nominal interest rates can go. And that floor is 0. If nominal interest rates fall below 0, that means you would pay your bank to hold your savings. Financially, you would be better off withdrawing your money and stuffing it in a mattress. Massive deposit withdrawals would destabilize the banking system. Of course, that's the theory. As the Federal Reserve Bank of Philadelphia pointed out, in practice, economists and policymakers have recently been surprised to find that even market interest rates can go negative, likely because storing cash can be costly and risky. Still, the reason why the Federal Reserve doesn't have an inflation target of 0 is if it did, there is insufficient room to stimulate the economy by lowering interest rates. The Economist newspaper points out, if inflation is low and real rates can't fall far enough to boost demand and perk up prices, demand will weaken still further. This is the dreaded deflation trap. Deflation is a period of falling prices, which can be difficult to overcome because households and businesses stop buying in anticipation of further price declines. This in turn further slows the economy and increases unemployment, leading to a downward deflationary spiral. Consequently, in order to avoid deflation, central banks set a target of inflation that gives them room to reduce interest rates when the economy is slowing and unemployment is rising. In fact, some economists believe that the inflation target should be higher than 2% to give central bankers even more flexibility, so 4% inflation target. But right now in the U.S., it's a 2% target that gives the Federal Reserve room to lower interest rates when the economy is slowing. And when the economy is going well, then they raise interest rates to prevent too much inflation. Hey, if you like this video, go ahead and subscribe to my channel. You can do that by clicking the button below this video. And if you have any questions on inflation and deflation, go ahead and leave them in the comments.